Hello, everyone. Welcome to our special webinar on Life Insurance 101, where we are going to take you through the basics which you need to know before you actually go ahead and purchase a life insurance policy. To tell you about ourselves, FinSim was founded in the year 2020 in order to provide ethical financial services to our clients. We assist our clients in achieving financial freedom with a systematic approach. We strive to simplify the complicated world of financial services for our clients. Most of our investment objectives are met through mutual funds. We also assist individuals in managing their risks through life and general insurance products like health and property. The webinar which we are conducting today is part of our initiative to spread financial knowledge. We are happy to boast about 100% star rating, which we have on Google from our existing clients. About the founder, that's me. I'm a certified financial planner by qualification. I come with a rich experience of over 15 years working with investment banks like JP Morgan, Credit Suisse, SocGen in various leadership roles. I have an investment experience of over 16 years, and I have managed to achieve my financial freedom at the age of 35. And I'm now coaching or guiding others to achieve the same. One of the favorite topic which I have is with respect to financial literacy. I try conducting these webinars for school, college students, and working professionals, educating them about the importance of financial literacy. We have got various tools, and we run our own blogs and video series on our website, which throws light on financial literacy and empower individuals in order to achieve their financial freedom. Our vision is to simplify the process of achieving financial goals. Mission is to guide at least a minimum of 1,000 families in achieving financial goals and improving the financial literacy of minimum of 1 lakh individuals. Our promise as a service is your portfolio will not contain any product in which we would not invest ourselves. Some disclaimers with respect to the webinar. This is strictly for education purpose only. We might be speaking about company names and mutual fund schemes. That's for reference purpose only. Please do not act on it until and unless you have consulted your financial planner. Views which we have expressed in this webinar are based on our trainer's vast personal experience and analysis. And this webinar is going to be recorded. This is going to be in listen-only mode. We would have 5 to 10 minutes of Q&A session at the end. The framework which we follow for financial freedom or financial planning of an individual is based on protection phase, upon which we are going to build on accumulation, and then we move on to distribution phase. In the protection phase, we give utmost importance to emergency reserve, that's creation of emergency reserve and maintaining it. Risk planning through instruments like life insurance and general insurance, that's health insurance or property insurance or vehicle insurance for that matter. Then we move on to financial goal planning, where we try to understand the life goals which an individual has, and we try associating that with a number, and then we will work towards how to achieve those life goals by proper systematic investment approach. Retirement planning is one such life goal wherein we will calculate what your current lifestyle is and what is the corpus which you would require in order to lead a peaceful retirement life. Estate planning comes at the distribution phase, wherein an effective estate planning done would not result in any family disputes or family members disputing amongst themselves as to who needs to own which property or which asset. When we are speaking about the protection base, our starting point is emergency reserve, and then we move on to different kind of risk instruments through which we can mitigate our risk. Life insurance is one such product wherein Life is completely uncertain because of all the external factors which we do not have control over. Life insurance companies provide beautiful opportunities via term insurance, wherein you can transfer your life risk to an insurance company by paying hardly few thousands on an yearly basis. Life insurance companies also provide you another option of critical illness cover, wherein in case if you were to fall sick because of any of the critical ailments like cancer, heart attack, kidney failure, liver failure, or temporary disability, in those circumstances, insurance company would pay you a certain sum of money as lump sum, which can be used towards meeting your financial obligations. These financial obligations are different from that of your medical. Now, the amount which is going to be provided as part of critical illness cover is a lump sum amount which is totally independent of the medical expenses which you might be incurring. Health insurance, a general insurance product with which you can transfer the risk of any unforeseen medical event to a general insurance company. How does it work? You need to pay about, depending upon your age, you might have to pay anywhere between 10 to 15,000 in order to have a life cover or health cover of about 5 lakh rupees. And in case of any unforeseen event happening, general insurance company is going to go ahead and take care of the medical expenses, barring few exceptions, of course, which needs to be studied in detail. And that's something which we are going to discuss in our next webinar on health insurance, where we will touch upon all those topics which you will have to be aware of before you actually go ahead and take a health insurance product. Finally, we come to say home insurance, wherein you might have purchased a dream home of yours, or you might have constructed a dream home of yours. But if you have not protected it by way of insurance, and if it is subjected to loss due to fire or floods, huge amount of money which you would have invested in your home will go in vain. In order to cover that open risk of yours, you can look at property insurance. That's a home insurance from any of the general insurance companies. Having said that, this webinar is going to exclusively speak about life insurance and the associated policies available with life insurance. We have different categories in it: term insurance, which covers only the life risk aspect of an proposer. We have ULIP, which is an investment and life insurance club together product. Endowment policy, which is life plus savings. Whole life insurance, wherein you can pay for a limited period of time, and that's going to cover you for all throughout your life. There are money back insurance plans, which you can go ahead for meeting some of your life goals. A retirement plan for planning your retirement, wherein you require a fixed amount of income on a monthly and yearly basis. Child plans, it's a part of, yeah, or it's something similar to endowment policy, but given the child names, wherein you can take the insurance in the name of your child, and then you can be the proposer, you can make the payment, and at certain intervals, in order to meet kids' higher education costs, it's going to reimburse some amounts on an year-on-year basis or different intervals. Let's study term insurance in detail. Now, what is a term insurance? A term insurance is the purest form of insurance which you can actually go ahead and get it from the market. For an individual who might be in his early 30s, he might have to shell out about 12 to 15,000 in order to take a cover of almost about 1 crore. Now, if I have to take my own example, if I'm going for a 1 crore cover with the policy duration being 29 years. Now, this is another topic which I wanted to discuss on. Now, the policy duration makes whole lot of difference because the probability of an individual's death would increase with age. Now, what is the most appropriate duration for which you will have to take this term insurance policy? If you were to ask me, my personal opinion is you should be covering yourself up till somebody in your family is financially dependent on you. Now, the moment there is no financially dependent individual on you, you can let go of this term insurance and you can look at your wealth, and then you can look at your wealth distribution aspect of it. For me, if I have to put that to put this particular number in terms of age, I would say I might not have any financially dependent person by the time I reach 60, or the maximum which I will stretch for myself would be for 65. Beyond that, it doesn't make any sense for me to actually go for a term insurance cover. Now, let's discuss about different options which are available with term insurance and which is the one which you should be actually going for. Nowadays, with the products getting reinvented every now and then, term insurance has got its multiple variants. One of the variants is a return of premium option. If I were to take an insurance policy for myself for a duration of 29 years for 1 crore, I might have to shell out about 17.7K as a pure risk premium, wherein in case if I'm not around, my family is going to get 1 crore. Now, there are other options like with a return of premium. Now, with return of premium, the premium amount which I'm going to pay on an year-on-year basis, that's not going to remain constant. That's not going to remain the same as 17.7K. Apologies. It's going to increase. In this case, it would be around 31,310 rupees. The difference of it is almost about 13.5K. In this particular option, if I were to choose this option, upon survival after 29 years, I'm going to receive 8,31,000 rupees. Bring smiles on many of individuals' faces when they hear that all the premium which you have paid is going to get reimbursed. But is it really going to work in your favor? Let's look at the next calculations. Now, the difference between the premium which you're paying, 31K versus 17.7K, is almost about 13.5K. If you were to invest this 13.5K, even with any debt instruments, which will be yielding around 7% interest on an year-on-year basis, cumulatively over the next 29 years, you would have accumulated almost about 12.7 lakhs, which is almost 4 lakh rupees more than what the insurance company would be providing you for. Now you might be asking me a question, who is going to give you 7%? If you look at the EPFO interest rates which are being offered, they are providing almost about 8.5%. Even PPFs are providing 7.1%. Why not go ahead and invest in these options rather than choosing the return of premium option provided by the insurance company? Now, let's take it one step further, wherein you might want to invest, considering your age, you might want to go ahead and take exposure in equity. The same 13,585 over the next 29 years is going to translate to almost 32 lakhs if we were to consider the return of about 12%, and would translate to 48 lakh at 14%, which is not an impossible return to make considering the historical returns which stock market has provided. Why not venture out to that rather than going with a return of premium option? 29 years down the line, 8,31,000 might not be a significant sum of money considering inflation. Let's move to other variant of term insurance, wherein you might just have to pay for a limited period of time and you are going to be covered for 29 years. In this case, 7 years. The premium is once again going to raise. 46.5K would be the premium instead of 17.7K. What's the difference? Close to about 28.7. The same invested with 7% translates to 3.1 lakh, and if the same were to be invested at 12%, you're going to make close to about 23 lakh. And at 14%, you will end up making 42 lakhs. What's the reason as to why we should be going for this kind of an investment? Now, here the factor which you will have to consider is after paying for 7 years, we are going to ensure that the difference of 28,779 is going to be funded. 28,779, which you're going to invest on an year-on-year basis, that's going to accumulate for 7 years. And from the eighth year onwards, you're going to withdraw 17.7 on an yearly basis in order to pay your term insurance premium. And the residual will still continue to grow in your equity mutual fund. I hope I was able to explain this without any doubt. If you have any doubt, please feel free to reach out to me on 9880627311. I will be more than happy to explain. Now, what are the different parameters which you will have to evaluate before taking up an insurance policy? One of the favorite term which most of the insurance advisors would use is this is going to be a guaranteed plan. What is a guarantee in it? Sum assured, yes. But do they guarantee the annual bonus which the company is going to declare? No, because even the companies would not know as to what kind of bonus is going to be declared by the company on a year-on-year basis, because that depends upon the profit which the company is making. Can anybody for sure tell me that they are going to make X crores of money in financial year 21 and 22? Nobody can declare this kind of an information. So where is the guarantee in it? Another important factor which most of us ignore are the internal rate of returns. Internal rate of return is a simple element to calculate, but do we calculate it before understanding whatever my insurance advisor is saying is actually true or not? We don't. Whenever the illustrations are provided by your investment or insurance advisor, they provide only the premium portion of it and they exclude the tax portion. When calculating your IRR, you need to also take into account the amount of tax which you would be paying on these insurance premiums, because that's going to hurt your pocket. That's money taken away from your pocket. How can you leave that for your IRR calculation? Illustration document, extremely important. Let's assume you have gone ahead with your insurance advisor and have purchased a document, purchased a policy. You are going to get a policy document in the next 4 to 5 days, or in some cases, about 10 days. Once you receive it, please go through the policy document in order to see that whatever your investment insurance advisor has explained, everything is covered in that policy document. If it is not, you have a free lookup period of 15 days. Please go ahead and return this policy. There might be certain amount of charges, but it is still better to incur those charges rather than having to live with that particular policy for decades, in some cases even 30, 35 years. In case of any doubt which you have with respect to purchasing a life insurance policy, please give a shout to your financial planner, who might be in a who will be in a better position to guide you on what policy suits you the best. You can reach out to us for any of your doubts for free consultations. Now, let's look at some of the interesting insurance pitches which we get over a period of time, and then how you might end up purchasing it. As I was telling you, one thing which two factors which attract us the most. One is free and another one is guarantee. Now, let's speak about guarantee. Now, in this example, you pay a premium of 15 years, and from 16th year onwards, you are going to get a guaranteed 8% on your sum assured for the next 55 years. Who would not like to go for a guaranteed 8% return on an year-on-year basis for almost about 40 years? Because considering the falling interest rate scenario of India, everybody would like to take this opportunity and then invest. Is it really 8%? That's something which you will have to evaluate. Now let's go to Excel in order to understand the IRR of this particular calculation. This is the example. If you are taking a policy in the year 2021 by paying a premium of around 59,000 for 15 years, you are going to get a life cover of 7.5 lakh rupees and 8% guaranteed claim, which is being made by your insurance advisor. That would be on your sum assured 7.5 lakh. you are going to get 8%. Of course, that is 60,000 on an year-on-year basis. But when are you going to get this 8%? After 15 years. This is the catch, which you will have to understand. 8% what you're going to get is not going to receive from day one. You're going to receive after 15 years. There is a concept called as time value of money. A rupee in hand today is more valuable than a rupee in hand tomorrow. Considering this, you need to understand that 8% which I'm going to receive 15 years down the line would not have the same value as in today. Let's calculate the IRR in this particular instance. You also are going to receive the annual bonus as well as the final accumulation bonus, final terminal bonus. This is being fetched from the insurance company's website, and also you're going to get your sum assured back. But look at the internal rate of return, wherein your insurance advisor was boasting about 8%, you are going to get an IRR of about 5.55%. Is it really worth it? It's less than the inflation rate. That's a question which you need to answer yourself. Proposal number two. You pay for 10 years, and from the 12th year onwards, you will get almost double of your premium paid for the next 10 years. Isn't it lucrative? You pay for 10 years, and from the 12th year onwards, you're going to get almost double for the next 10 years. Who would not want to go for it? Now, let's look at what IRR says. 1 lakh rupees, including tax, would translate to 1 lakh 4,500 in the first year, and from second year, 1 lakh 2,500. You pay the premium for 10 years, and from the 12th year, you are going to get 1 lakh 93,000 odd. You calculate the IRR, 5.89%, less than what the inflation is going to take care of. 20 years, and you have time to your advantage, but you're going to get 5.8%. If you're comfortable with receiving 5.9%, please go ahead with this option, but you will have to evaluate and you will have to arrive at the IRR before you actually decide on whether this policy is for you or not. Option number three. You pay a premium for 15 years, and from 16th year, you will get 15% of sum assured for the next 5 years for kids' education and residual 25% on maturity along with bonus. This is one of the variant of child plan which we were speaking about. Once again, let's go through the same option of IRR. 6,375 paid for almost about 15 years. From the 16th year, you're going to get about 15% on an annual basis, and the residual on maturity along with the bonus. How much does the IRR translate to? 5.43%. Once again, if you're looking at a child plan, mind you, the inflation for education is at 10%, not even at 6%. Can you afford to make this costly mistake of not judging the inflation properly? Question for you to ponder on. Option number four. You pay for 35 years, get sum assured along with yearly bonus and final bonus at the end of 35 years, and get life insurance till the survival of the individual. That means sum assured, you are going to get the sum assured after 35 years, but your life cover is still going to go on all throughout your survival period. This is the whole life insurance variant which we were speaking about earlier. Now let's look at the option available out here. You pay 3,165 for 35 years. You are going to get 1 lakh rupees sum assured plus the accumulated bonuses amounting to 1.56 lakh. What's the IRR in this case? Worse than 5%, 4.46%. Of course, the reason for this is the lifelong cover which the insurance company is going to provide you. Nobody is here to do charity. Insurance companies also are not here to do charity. They are going to take this forward. They are going to retain some of the money out of this particular policy in order to cover that open risk. Now, when you look at the IRR, you will automatically be able to make out why do you have this 4.46% versus the other policies of which were giving at least about 5.4%. This is the calculation which you need to do before you actually purchase any insurance policy. In fact, this is something which you should be asking your insurance advisor to provide before you actually engage that insurance agent for your financial planning purpose. I would really appreciate you guys leaving any feedback. If you have any questions or concerns, please do raise it in the comment section, and we will do our best in order to come back and then answer those questions of yours. We are always there at your service. If you are looking out for a free consultation from us on how to achieve your financial goals, please feel free to reach out to us on my email address, support@finsim.in, or you can reach out to me directly on my cell number 9880 You can also go ahead and look at our Facebook and LinkedIn profiles. Please feel free to visit our finsim.in website, which is going to give you information in terms of through blogs. We have various calculators which would help you in understanding your insurance requirement. Let me take you through my website with which you will be able to understand. If you go to the calculators page, we have few calculators like retirement corpus, insurance cover, future value of lump sum investment, and future value of monthly investment. Now, with respect to insurance, you can click on the insurance calculator, wherein if you give general information in terms of what your monthly expenses are, and if you have kids, what their higher education cost, which you are predicting as of now, and if you have any other goals, what is the financial value of it as of today? And then if you click on the next, you are going to receive an email which would contain the ideal insurance corpus which you will have to go for. Similarly, we have retirement corpus as well, wherein if you provide in detailed information in terms of your age, your retirement age, the life expectancy, and other financial information of yours, you will get a customized calculation which would actually indicate what is the ideal retirement corpus which you should be going for and what is the monthly investment required for it. I hope you found this webinar to be useful. Feel free to reach out to me for any other clarifications. Thank you. Thanks for your time.